All right. Welcome back to another CPI, or as some like to say, CPI inflation report. We have no idea what's going to happen here, unless, of course, you were watching the stock market maybe about an hour and a half before the close yesterday, and all of a sudden the crazy old red candlesticks we got out of freaking nowhere. Some people say it's because the Fed was starting to redefine what they were looking for in terms of actually wanting to cut rates. Some indications that they're looking now for quote-unquote broadening disinflation. Some folks thought, oh, here we go. It's a sign that the Fed's now going to redefine everything, and it's going to be a whole lot harder to actually end up getting the Fed to cut. That all started yesterday. We can take a look at that. We'll zoom in here. So we've got red markets now. I always love the theory that CPI has already leaked. But look at that drop yesterday. This was sort of the thesis here, that right around 1:30 p.m. bloop. That would be Eastern time. You started getting a little bit of a drop there about 2.5 hours before the closing bell. Who knows? But what we do know is that we, as the plebs, are all going to know in about 8 minutes. We are 8 minutes away from knowing what that HE double hockey sticks we are meant to be told. So we'll cover those numbers in detail, obviously. Pretty excited about that. We have these estimates that we could start kind of peeking at. We looked at JP Morgan yesterday morning, and JP Morgan yesterday morning gave us a little bit of a heads up. Then we also did go through some other forecasts and consensus forecasts. May as well take another quick little peek at them just to get a little refresh reminder as we gear up for the actual numbers. So let's see here. First, we've got JP Morgan that thinks we've about a 2.5% chance of coming in with a number above 0.40. So in other words, 40 here for CPI. Not very enthusiastic for a core read. This is core, CPI core, of above 0.4. You can see that here. They give only a 2.5% chance of that actually occurring. Then we have a 22.5%-ish chance, so pretty low here belief by JP Morgan that we're going to get something like this, but we do have this belief 22.5% of us getting a number between 0.3 and 0.4, 45% chance between 0.2 and 0.3. So that seems to be the most important line there. Remember, for the CPI inflation report, we're not necessarily, as Jerome Powell put it, looking for better CPI data. We're looking for good data, which could actually even be worse than the data we've previously gotten. So, in other words, we could get CPI that comes in a little warmer, than what we've had, which I think would probably lean towards maybe like, coming in at 0.3 again, right, on core. Although I wouldn't like to see that. I'd prefer to be closer to like, well, frankly, the best case scenario would be having core just level out at something that averages out or annualizes out to something under 2%. But to annualize out to 2%, you really got to be at like, oh boy, 0.018 probably times 12. Yeah, 0.017. 0.017 would actually get you to an annualized 2%. So my guess is better but not, good but not as good might be something like 2.2, 2.3. Who knows if this is going to be the time we get that, especially given that expectations right now are that we are going to get a 0.3 read. So we shall see. Now, if I jump to Nick T, he throws up some consensus estimates as well. Of course, quickly on JPM, we do also give a 25% chance here of getting a miss in the positive way of 0.1 to 0.2. 5% chance of something below 0.1. Notice how they give a 5% chance of something below 0.1, only a 2.5% chance of something above 0.4. So it really seems to be, we've got like this 67.5% chance here of having something between 0.2 and 0.4. And a lot of this depends on how they end up rounding this figure as well. To get under 0.3, let's look at the rounding here. The current estimate, if I go with core, is 314,084, 314.084. You could divide that number by the prior read of 313,216. That puts us at 277. So the current forecast is that we're going to be at point, you can see me write that there on the left, 277. That gets, that ends up getting rounded up. Oh, where'd it go? That gets rounded up to 0.3, so just mechanically you can see how that works. We'll calculate that since we are rounding. We can run that pretty quickly. All we're going to do, and I'll read the number out, but all we're going to do is we're going to divide whatever new number we get. So x, let's write that down. We're going to go x divided by 313.216. Obviously, I have to multiply by 100. Well, subtract 1, multiply by 100. Yeah, but all that generic stuff you typically don't even have to do. You just look at the number. So anyway, we'll have that in about 3 minutes. So that'll be exciting. Going over here, you got Nick T, also known as the Nicky Leaks. Nicky Leaks Leaker. Wall Street forecast expected to be 0.3 on the core, lowering the 12-month core to 3.8, a touch, with headline but just 0.15, dropping the 12-month read to 2.9%. So that would be great. 2.9% on the headline would be fantastic because it really starts getting us on headline close to 2%. I mean, we're in the twos. Great. Year-ahead inflation expectations. Look at these. Look at this crash of inflation expectations. So low. A number so low. We haven't seen it in, well, since before the pandemic. Jump into the good old bondy-wandy market. Bondy-wandies. Let's look at the 5-year break quickly before our numbers come out here. 5-year break even, 2.29. Boy, we've been there forever. How boring. I think the 5-year forward is actually more entertaining because the 5-year forward actually came down. Let's see here. Yeah, there we go. Okay, now it's actually loading. Okay. 5-year forward, yeah, down at 2.21. Wild. Okay. Here we go. So we are now within a minute of this data coming out. Again, quickly, expectations are across the board 0.2, 0.3, 2.9, 3.7, and yeah, it's gonna be crazy. All right, who's ready? If this makes you nervous, remember, you can still get life insurance in as little as 5 minutes by going to metkevin.com/life. I don't think you'll have enough time to get life insurance, though, before this number actually comes out. Here we go. Okay, it's all hot. Damn it. 0.3, 0.4, 3.1, 3.9. It's hot across the board. So the number we were going to divide by was 314,438. So CPI did leak. 314,084 divided by, yeah, there we go. Okay, 314.438 divided by 313,216. That was actually, wow, comes in 3.9. Instead of 2.7, you got 3.9. So on this number right here, you got 3.9 is where it came in. So you came in right above here. And the worry here would be clear signs that core inflation is accelerating. I'll pull up the doc. Let's listen in here for a moment.
Year, we were expecting 2.9, but did make progress versus the rearview mirror, which stands at 3.4. Now, if you consider 3.1, we've already been there. We were there in November of last year, and we were at 3.0 in June of last year. Finally, CPI year-over-year core, I think one of the ones I'm paying most attention to, 3.9%, exactly as the...
Okay, we already read that stuff, so I just wanted to get the doc up here. So CPI increased 0.3% in January on a seasonally adjusted basis, after rising 0.2% in December. BLS reported today, over the last 12 months, all items increased 3.1% before the seasonal adjustment. All right, fine. Index for shelter continued to rise in January. Why? Look at this. Shelter rents just still not going down. That's definitely what drove this up, contributing over two-thirds of the monthly increase. Well, it's taken longer to get that real estate pricing down. That's why. Oh, there we go. Look at that. There, that's much better. Okay, the food index rose 0.4 in January as food at home increased 0.4%. Food away from home index rose 0.5%. In contrast, energy fell 0.9%. Okay, let's see here. We have the index for all items less food and energy rose 0.4 in January index, which increases January motor vehicle insurance, medical care. Okay, so this is your core. So core had motor vehicle insurance, shelter, and medical care. Okay, well, two of those are very lagging. Index for used cars, trucks, and apparel were among those that decreased over the month. Okay, let's grab these categories. And what we're going to do is we're going to go all the way to the bottom of the actual detailed categories. And we'll find out quickly the suits here. We still have a 3 handle on core year-over-year inflation. Yeah, unfortunately. That's surely going to raise questions about whether May is really in play for the Fed. There you go. Now you're starting to get talk about potentially that, delayed rate cut of even May. You're up 11 basis points on the 10-year Treasury. Holy crap-a-rappas. Okay, so we're going to go all the way to the bottom of the CPI report. We're going to scroll up from the bottom because this is where it's most important. All right, and then quickly, just so you can see the chart, the way it works on the right, we're looking for that seasonally adjusted December to January month-over-month figure. And we're going to go all the way to the bottom here. And what do we have? So we have financial services. Not sure how they went up 2.4% in a month-over-month period, but okay. Apparel services other than laundry up 1.5. Laundry 0.7, funeral 0.4. That means other personal services up 1%. That's quite a chunk there. Then you've got, let's see here, education and communication services up 0.4. So both not great here. Both things that sort of suggest this continued broad-based push of inflation up. In fact, we should really be using a red color here because, I mean, look at this. Postage up 1.4, postage delivery up 1.2, telephone services flat, but who uses that anyway? Personal services 1% here. Not great. Haircuts, personal care services up 0.7. Some arguments for this being just a January issue, but then again, you have the ability to seasonally adjust some of these figures too. But anyway, education and communication services 0.4. Let's find out first where the drama is, and then we'll talk more. Pet services up 0.9. That's 2 months in a row we've actually seen pet services move this much. Recreation services 0.4. Public transportation, once again, 1.3%. There it is, motor vehicle insurance, 1.4%. Motor vehicle fees, 1.1%. Not great. This is somewhat broad-based here. You kind of have these numbers ticking up everywhere. With the exception of here, you've got car and truck rental, negative 0.7. That's fantastic. You've got transportation services at 1.0. You've got, there's health insurance, very, very lagging. You could see how it's just frequently been high. Very lagging and very normal for insurance to lag. But it's not so normal for hospital services to be up 1.6%. Holy smokes. That's not great. Treasury yields, yeah, across the board, way higher here. You've got, let's see here. Yeah, up 11 basis points on the 10. And then the 2-year Treasury is sitting at, let's see, Oh, it's not loading for some reason. Whatever, it doesn't matter. Okay. Looks like we have medical care services. There it is. Yeah, 2-year treasury. Oh, that's not up as much. Interesting. It's really the 10-year that's up 12 basis points. Anyway, medical care services 0.7. We've got water sewage collection 1.1. I mean, across the board, these January numbers are not good. Is this unadjusted? Hold on a sec. Oh, look at that. Seasonally adjusted. So I don't know what happened with those seasonal adjustments, but whatever happened in January, it's like, oh yeah, no, it's all over. I mean, photographers up 0.7 over here. Subscription video game rentals negative. Who cares? You've got, let's keep going here. It's not great. Let's see. Yeah, look at this. Shelter was starting to decline. You know, you had a 0.4 read, a 0.4 read. What do you get now? 0.6. And that consisted of 2/3 of this CPI beat. Not great. Lodging away from home, 1.8. It's also pretty high up there. Personal care products, 0.5. Other goods, no goods reinflation, at least that I can tell. Alcohol away from home, people will be needing that today. It's okay. It's at 0. Then you've got alcoholic beverages, 0.3. You've got education commodities at 0.6. A lot of negative here, though. A lot of negative in the goods. Other recreational goods, negative 0.8. The goods side is really seeing the pain. 0.8 on toys, 0.8 or 0.6 on toys, games, hobbies, 0.8 on what do we got here? Recreational goods, recreational reading materials, negative. Photography equipment, that popped up a little bit here, 2.2%. But again, you know, most of these, well, you've got sporting goods over here, 0.2. Seems like, yeah, look at that. Pet food only up 0.1. That's not bad. Recreation commodities. I don't even know what recreation commodities are, but they're up a bit. I guess that includes audio and video products. Okay. What else do we have that's negative here? Medical care components. Medicinal drugs. Prescription drugs. Non-prescription drugs popped a little bit, but small weight there. But you have a lot more negatives over here in the goods. Oh yeah, look at that. Used cars and trucks, negative 3.4%. New vehicles, 0 on new vehicles. New cars up 0.2, whereas new cars are down 0.1. These are all pretty benign numbers here. So really, look at that. Transportation commodities, less fuel, negative 0.1. Footwear's down almost 1%. Women's dresses down negative 3.8. Women's outerwear down negative 3.8. Negative 1.6 for women and girls apparel. What do we got? Men's underwear, though. Oh, that's interesting. Men's underwear. It's the Heinz Index. What's it? No, the Haynes Index, or whatever people call it. Up 2.5%. Men's apparel, 1.2%. Household cleaning supplies, 0.4%. Tools and hardware down 2%. Tools and hardware across the board down 0.7%. A lot of negative here. Look at that. Appliances picked up, though, 0.9%. Furniture, bedroom furniture, living room furniture. I think there were some seasonal adjustments at play here because those are some hot numbers. That susses me out. That's actually really weird. That right there is a red flag to me. Red flag that furniture is so positive. Really suggests some seasonal adjustments. Although we'll look at the non-seasonal as well in just a moment. We shall see here. Energy negative, fine. Yeah, then we get into sort of foods and things like that. Beverages, including coffee, 0.5%. So some extra push over here on non-alcoholic beverages, beverage materials. That's a 1.2. That's not great. Fresh vegetables, 2.4. That's not great either. Oh, there's a lot of not great in here. Fruits and vegetables, 0.4. Yeah, I mean, you just killed any kind of... Any leftover... Here's the unadjusted. Any leftover chance there was of March, which pretty much should have been unpriced already, is gone. Banking crisis doesn't even matter, so don't rely on that. So unadjusted changes. Just quickly to compare maybe some of the more severe to see, are we talking adjustments here? No. Financial services, sorry, wrong one. There we go. No, that's not adjusted. No, actually not really. These numbers are actually very similar to the seasonal adjustments. If anything, right there, the seasonal adjustments took them down a little bit. Yeah, no, these numbers are very, very, very similar to what the numbers actually were. Nominal differences here. Tiny little bit up, tiny little bit down. But there's no major... Here's a seasonal adjustment. Car and truck rental. The non-seasonally adjusted was 6.8%. But they brought that to 0.7. But, then you look at transportation services and, the seasonal adjustment made it a little bit worse, but not much. Health insurance was the same. No, I can't do it. I can't blame. I mean, here, lodging away from home, that got revised down, if anything. If anything, the seasonal adjustments actually helped here, which is even more depressing. So, let's see here. No. Yeah, what? Yeah, nope. No seasonal adjustment there at all on furniture. So I have to cross that out. That's not going to work. Can't rely on that. All right, let's see what the suits are saying. But yeah, no, these are not... It's had nothing to do with seasonal adjustments. Okay, so Fed swaps full pricing of rate cut to July from June. That's for the full pricing. We still had like a 60% shot for May, but I think that's now evaporating. Bond yield spikes, stocks drop, not a surprise. It's kind of what you expect after this. 3-month annualized running rate. Of course, CPI is accelerated to 4% from 3.3% in December. Not great. So you've got a little bit of a tick up on the 3-month running rate. Although the trend is very clearly down, this definitely pushes you up a little bit. We don't really want to see them. Are they saying anything interesting?
And the question I had, which is, if it ain't broke, as in the funds rate, how much fixing should the Fed really be doing? And maybe the idea is it needs to do less in terms of cutting rates to bring it down to the right neutral rate than you thought previously with low unemployment and relatively strong growth.
Yeah, no kidding. That's possible. This is the what it looks like, that chart I was talking about. This chart is the annualized core CPI change. And this shows you that you are trending down, but on the 3-month, you're definitely in a situation where you've seen some uptick there in the last couple months. Again, I don't know how much of this is January. I don't think it's the seasonal adjustments. The only thing that, I think the only saving grace you could really have is hoping for a really soft February, mostly because you have this real potential that people or companies or whatever are just used to raising prices in January. Again, that should show up in the seasonal adjustments, but then again, the seasonal adjustments didn't do too much for us here, so who knows? But that's something that that folks will be thinking of. So, anywho, so let's see what else we've got on the suits here. We've actually gone through the numbers pretty clearly here, and let's go with the suits. Drop on the S&P. Yeah, we did see indices drop a bit. I'm actually surprised the market's not down more than this. You've got... Oh, Enphase gave up all of its gains yesterday. Thing was up like 6% yesterday. I think it's down like 5.5% right now. Here are the Qs. So it's just giving up what it earned yesterday. Here are the Qs, down 155. That's how you know something's interest rate sensitive. And what's interesting is Tesla, while it's down about 2.3%, it's not down more than this. It really makes it seem like Tesla's almost kind of like stuck at close to its potential local bottom. How's BTC reacting to this? Let's take a peek. We did cross 50K yesterday. Yeah, a little almost overreaction there. Went from about 50 down to 49.2. Sort of moving up again here slightly. But, okay. Let's see here. There is now no chance of a Fed rate cut in March. So write that down. March fully unpriced, and then let's write down. Let's do a quick little sort of outline here of some of the nonsense that we're going to have to deal with now. So, number one is March rate cut, fully unpriced. Okay, great. Then what do we have? Then we have... Okay, this is like the worst. Okay, this is so stupid. Forget that. Okay, so March is fully unpriced. Then we have, what's it called? May, that's sitting at a third. And, okay, let's see here. Grocery prices rebounded in January. Yeah. Okay, there we go. March unpriced. May odds of cut at 1/3. 1/3. Then we have July now fully pricing in rate cuts from June. And again, that number, instead of, let's see, market expectation was 2.7% for, or I should say 0.27%. That's what it was. 0.27% for core CPI core month over month. We got 3.9, right? Oh, is that what I wrote down? Double check. That was a pretty big read there. Looking at the JPM report is where we threw that. There it is. Oh, we got 3.9. Wow. 0.39. That's a pretty big read. And then, of course, we were looking at a headline read. I can also run the numbers on headline. So headline was 0.4 versus 0.3. But let's actually compare expectation versus reality here. 308,014 divided by 306,746. We were looking at an expectation of, okay, well, that's what we actually got. That's about right. That's 4.1. And then the expectation was that. Okay, that's 4. Hold on a sec. Headline, the actual release. Let's divide this correctly. No, that's right. Survey divided by the number that we had. So we were looking for a headline month over month of 0.2. Okay, that's nominal. And we actually ended up getting 0.4. Hold on a sec. This is being a little funny. Okay, I'm just going to read it off without doing the actual decimals here. So CPI month over month came in at 0.2 versus the 0.3. And then the CPI core year over year, 3.7 versus 3.9. Okay, there we go. Okay, so let me see what else the suits are saying. Oof, I guess you could take March even more firmly off the table. Maybe dispense with May 2 while you're at it. January CPI figure exceeded expectations, both headline core. Yes, we talked about that. Let's see. 3 month, adding insult to injury, the headline figure didn't even make it below 3%. It's at 3.1. This is an invitation for Fed hawks to spread their wings. Never heard that one before. Oh, here you go. Core services X housing rose 0.85% on the month. Oh my gosh. Core services X housing up 0.85%. Yeah, that's when we were going through and looking at those services sectors. That was not good. That's like annualized that annualizes out to 10.2%. So what a hot January. Holy smokes. Let's see here. Only three of the 68 economists surveyed predicted a 0.4 on the month-over-month CPI increase. Everyone else had expected a slower pace of gains. Looks like it's a good time to pick up a used car. Yeah, probably. Lower volatility sectors within CPI have increased the past 2 months. So low volatility is moving up higher. This may suggest inflation remains stickier than doves may hope. Yeah, I'm surprised nobody's talking so much about January. Maybe they think, because the seasonal adjustment wasn't that big. But grocery prices rebounded in January a bit. Insurance observation. It wasn't just insurance, though. Insurance definitely jumped. Year-on-year increase in car insurance, biggest since 1976. Yikes. Okay. Goods disinflation continues. Prices for commodities, less food and energy, fell 0.3%. Motor vehicle insurance, medical care, okay, rent, one of the factors stoking inflation. We saw that. Okay, so those are the suit comments. That super core is not great, so this is going to be, I'm going to call it super core. No bueno there. Let's listen in here for a moment.
Actually, inflation expectations.
So like I said, yeah, you need life insurance. I pitched that right before the report came out. metcavin.com/life. Get life insurance in as little as 5 minutes.
Keep its course, keep rates high for long enough. They have to err on the side of being a little bit tighter rather than being too easy. The last thing they want to do is start cutting rates and, in fact, not do the job and then have to raise rates further. Then we do get a recession. And that's really a problem. So I think they have to just be very cautious. So, you know, I just would say that I was agreeing with everything you said until you said, well, you know, my old story was that they should be cutting rates a lot in the next year. And that I was very skeptical about.
Watching the, no, I don't want to, but watching the stock markets reckoning with rates not coming down as quickly. We've seen that for the past month and a half. You know, we no longer thought it seemed so likely near term that we'd get, you know, a rate cut or as many rate cuts. But the market held up pretty well. But that's when the market was still thinking we've got this nice economy, but with low inflation, with disinflation. This is the first data point where that thesis, and you say maybe it's a one-off, but now suddenly maybe players are realizing, wait a second, when you have a hot economy, you're not going to have inflation. That's too good to be true. It's not Goldilocks.
Well, I think also people just were too optimistic about the Fed cutting. I just think that was wrong. That has been my view for quite a while. The Fed has made it very clear that inflation is their number one objective, and that they are now getting it right, and that they actually had said continually, well, we would risk a recession. Well, the numbers came in much better. We've had a bad number here, but it really doesn't change the Fed's game plan. The Fed was very unlikely to cut at the next meeting. And I think now that's even more true than it was before. I think they're going to be very cautious on lowering rates. And I think that's the right thing to do. So this is not out of their game plan. I think the market's just got ahead of the Fed.
No, it just seems like maybe we had thought that the Fed had done its job on inflation and wasn't going to have to cause that recession that we all thought. And even the Fed thought, you know, unemployment rates need to go up till we really harness inflation. We thought that we were going to maybe get a free lunch, that you didn't have to do that. And if inflation stays stubborn, that's when you bring the recession back on the table because the Fed has to stay too high for too long.
Yeah. So, you know, look, this is a tough, I always felt that the probability of the Fed engineering a soft landing was very low. And that it's really tough. I mean, when you've had inflation go way up and you've made mistakes, getting the glide path down is extremely difficult. In fact, this would be unprecedented if the Fed was able to do it. However, the numbers look much better than expected. I should also mention that the labor markets actually are not as tight as people think. The Fed's made a lot of progress in terms of better measures of labor market tightness. In fact, a really good measure that I think is better performance than the unemployment rate is vacancies relative to unemployment. And the Fed has actually had a substantially loosening of the labor market from its very tight period earlier on. So they've had some success there. That's good news. But the bottom line is that this is going to be tough to do. I think the good news is whatever happens is not going to be too bad. The Fed has actually engineered situations so they don't have to clobber the economy. But they got a tough job to do. This is just not easy to do. And they're doing pretty good, but they're not perfect.
Should have never put up that mission accomplished banner, Rick.
Oh, absolutely. Don't wear that stupid flight suit.
Oh, that wasn't the Fed. That's right. That was that happy
don't wear that flight suit.
That was that happy ex. That's right. Rick, thank you. Rick Michigan.
You're very welcome.
Okay.
You know, I wonder, it does make you wonder, did the Fed know, right? Like, I think it's so interesting to sort of think about that potential. You know, did the Fed know that, you know, this was going to come in hot in January? And Jerome Powell kind of had to do a little suggesty doodling that, hey, you know, even if it comes in a little warm, well, we're not going to cut in March, but, you know, we just want to see the trend is good. remember the last time Jerome Powell, he was oddly sort of anti discussing this potential for analyzing 6-month data. He just refused to look at the 6-month data until he was finally cornered and had to, essentially. And I thought it was so interesting. I'm like, why is he so reluctant to look at the 6-month data, which was great? I think this is why. Because as you see on screen here, the 6 and 3 month can actually pop off. And when you have a 12-month outlook, you know, what you're doing is you're looking at this blue line right here. It's very stable even with these changes. But look at the fluctuations on the 3 and 6. You're actually suggesting that the inflation declines bottomed. And now you're sort of re-accelerating here, right? That's really what you're getting here. Medical care services were no longer a drag in January. Other personal services picked up. Yeah, I mean, when I went through it, it did seem pretty broad. Let's see here. I'll look at this. Yeah, we'll look at this one together. This will take just a sec to pull up here. This will give us some broad. Okay, so let us see here. We are going to go with this number. By the way, if you have any warrants with House Hack, remember that warrants have been called due, so I think we're about 57 days away from House Hack warrants expiring. Keep that in mind. Go to househack.com, click on the little investor tab to learn more. Okay, so what do we have here? So here's the super core figure, which, you know, it's obviously a bummer that it's going up, but it is what it is. I wonder how much we can attribute to January. Let's try to clean this up a little bit here, and let's go with annotate. Oh, I want an arrow ideally. There we go. Okay. And then we're gonna go with an arrow. We're gonna go here. All right. So you could really see we've got, I mean, even the December figure, December and November were right here. So you came off the bottom a little bit. This right here is January. And really what you're looking at is medical care services were a drag right here. This was all negative, medical care services. And just like transportation during COVID was massively negative. But as you can see, transportation and rec services over here, they're sort of leading the way of core inflation here. But it's not just that. I mean, you had the rec services, the other personal care services, the education sector, all of them. You even had there's medical care services. You could see medical care services going from negative to being a drag, basically, to being a contributor. Well, okay. So Fed officials are counting on a slowdown in shelter costs to bring inflation down, but those are proving sticky. Rents rose 0.4% in January, the same as November and December, while owners' equivalent rent jumped 0.6%. Very interesting. Let's listen here for a moment.
20% of loans are maturing this year and need to be refinanced. So I think as the year goes on, we're going to see more of an impact from the higher interest rate environment, which will further facilitate the Fed's plan to lower interest rates this year.
Brenda, I want to thank you for your insights as we looking at this news crossing the wire. Just to repeat where we are on the markets, Dow, which was down about 50 points, now down 343 points. S&P 500 looking to open off about 61 points. The NASDAQ looking to open off about 291 points. We could do one of those games where you have to try to figure out where the end of where
does
the
it come back or does it come back or does it get worse?
Guess what? You all get to find out, and we'll get to talk about it tomorrow. Make sure you join us then. Squawk on the Street begins right now.
Okay, so just looking at some reactions here, Nvidia's down 2.1%. You've got Bitcoin down at 49.5, which realistically is still up. You can see the regionals taking a little bit of pain here, 5.5% on the regionals. Wow, Cloudflare went over $100, but it is down 2% on the day yesterday, 6% today. Then you've got 5.3% to the downside on Palantir. Wow. Super Microcomputer shaves off another 2.4%. PayPal shaves off 3% off Taiwan Semi. I mean, you're across the board. Looks like some good pain here today. Etsy's down 5%. Holy smokes. Wow. Ubiquity was up 9% yesterday. Okay. And Starbucks down 0.81. Microsoft's down a couple. Yeah, you know when Microsoft is down a couple, it's a little bit of a sign of broad-based selling. Apple's down 1% here. So, no joke. All right, let's see some other insights we can just glean here quickly. Again, the biggest thing here is just this broadening of, unfortunately, inflationary pressures. We don't want that. But just because you don't want it doesn't mean you can't get it. So, getting some pain there. The other thing to look at, let's see, what is this? Deviation from baseline to forecast. Oh, yeah, okay, well, had a little bit of a spread there between what everybody was expecting and what we ended up getting. No kidding on that. So that was a little bit of a shocky doodle, but that's okay. I think it was 4 economists. Let me write this down. Yeah, 4 economists out of 68. 68 expected this high. And keep in mind, we got JP Morgan, which was really only looking at about a 25% chance of this happening here. If you add in the 2.5% there as well to the 22.5. So the worry here is core inflation accelerating. And I think that's exactly what we got. So I would say that is a bit of a concern. Rate cuts aren't justified in the near term with GDP as high as it is. Yeah, I could definitely see an argument for that. Let's take a look at GDP, mind you. So if I go to Fed now, Atlanta, real GDP. Okay, here we go. So current estimate is as of, okay, well the next estimate comes out in 2 days. But the current estimate throws our GDP at 3.4%. So you're definitely up there on GDP. 3.4% current Q1 GDP estimate. So remember, I like to throw summaries over at ehack.com in case you're ever wondering or want to see it. You're welcome to do that. Check out ehack.com. The next comments we're getting here, looking at the actual rate of inflation and focusing on the level of disinflation in goods and services, it looks like everything is running hotter than hoped for. Yeah, that's definitely one way to put it. I mean, I went through it line by line, and that's kind of how I felt about it, too. It's like, oh, I don't know, man. Like, the only way to write this off is by saying, hey, is this a sign of January hikes? You know, people raising prices in January, and that's it. Because you're certainly not seeing this on goods earnings calls, most corporate earnings calls, even for services. You're seeing the opposite of this. So to see this kind of reaction here is a little wild. You're getting, it looks like Apple, which is trying to show a little bit of like green life there for a moment, though. I don't know, that's probably just going to be clickbait. I think you're probably going to end up getting worse before you get anything better over here. If we look at actual bonds, yeah, they've settled a little bit too. You're up 10.5 basis points, which puts you at 4.275 on the 10 years. So write that down. 10-year up 10.5% to 4.27%. Yikes. JP Morgan Asset Management tells Bloomberg TV the report isn't that bad. The economy is cooling. It's just cooling more slowly. Okay. Yeah, that's a nice way to put it. See, the other issue that you have with, or you'll have with the Fed is the Fed will be very concerned about stagnating. Any kind of stagnating of inflation progress, very bad. Inflation suggested by Supercore. So I would write that down as super bad. Super bad. That's what we should be calling Supercore from now on. It's just super bad. Okay. So let's see here. let's go with... Let's take a brief listen here. See what Jimbo's yapping about.
Home up 0.5. That's another big jump, Jim. I know the other day we had Pepsi pricing after quarter of double digit. Still up 9 in the most recent print. And, of course, James Quincy of Coke today talked about their quarter. Take a listen.
Another important factor to highlight is the inflationary pressures, which are moderating or stabilizing across most of our markets. To keep consumers in our franchise, we are leveraging our revenue growth management capabilities to tailor our offerings and price pack architecture to meet consumers' evolving needs. In North America and Europe, while inflation is moderating, the cumulative impact of inflation is pressuring certain consumer segments who are seeking value. Throughout 2023, we increased our affordability offerings and won volume and value share in both regions.
So we're going to talk to James Quincy in the next.
Well, that's the thing. We've constantly seen them talk about in their last earnings call. I went through that line by line. I'm like, yeah, nope, that's not a big sign of inflation. But anyway, what is this? Look at this. Paramount Global lays off 800 employees a day after announcing record Super Bowl ratings. Nice. It's odd timing, but okay. Interesting. Okay, so what else? Let's see here. If there are more Nikki T tweeties. Nikki T tweeties. Let's see here. Goldman's CPI projection was very close. We expect a temporary boost to core CPI from start of the year price increases, which may be most pronounced in prescription drugs, car insurance, tobacco, medical care services. How interesting. So Goldman did have that argument that I have. That's what I think. And who knows? Maybe, you know, that's just like, oh, you know, bias, tilt, or whatever. We can think whatever we want. Everybody has the right to their own opinion. But that's my take. And I think that's very interesting because they're the first ones that I'm seeing that actually have that same take. Nobody else has been touching on that. So I like Nick T here quoting that because I do think that's very likely for January. It makes logical sense because that's just generally when you do your price increases. Now, let's write that down. So that's Nick T suggests via Goldman. Or I should put that the other way. Goldman suggests via Nick T. There we go. These bumps could be related to January price hikes. And again, that would be above the seasonal adjustment. So we won't know until next month. So it's possible that you have a Fed that's basically like, okay, let's get through January because we know January is going to be silly. So get through January, and then after you get through January, you end up getting a Fed that says, okay, let's go with 2 inflation reports thereafter, right? So remember, March meeting from Fed would have 2 CPI reports. That's Jan, Feb. Okay, well, we know that's not really enough for them because now we just got a hot read here in January, so that's not going to work. So really what you need is you need 2 reports after that. So if I go 2 reports after that, what is the May 1 meeting? So May 1 meeting, let's write that down. May 1 meeting gives Fed Feb and March. And then June, let's see when the June FOMC is. June, which is another what's it called? SEP meeting. CPI schedule of releases. Let's line that up as well. June. Ah, interesting. June 12th is a special day. How special is it? That's what you're supposed to say. So June 12th is an FOMC meeting day, an SEP day, and a CPI day, which means the Fed would get May. Basically, they would have Jan, Feb, March, April, May CPI reports released. Wow. Okay. That's very interesting. So June gives you 5 months of data. And then you're probably able to say, look, January was January, then you had 4 months maybe of normal again. Or you have 4 months of hot again, right? Nobody knows. But the point is, the Fed would know in that time frame whether they have their 12-month reads on inflation where they want them. So I think that's a quite interesting potential, and it's something that I would be paying attention to. So I'd be looking very closely at the June meeting. Let's look at the Fed rate monitor. Fed rate monitor. We are at 95%, no cut for March. I'm surprised there's even still a 5% chance. Like, somebody still has hope. It was crazy. Hope should be nope. May just got cut down to 43% chance. And then June, June's not even that great. I mean, you're somewhere around 76, 77%. And that's potentially another guidance meeting, too, where they could just use the summary of economic projections. Remember, the summary of economic projections is a really interesting tool, and the Fed really likes to, guide what they'll do in the SEP. Somebody here says they'll cut right before the election. They'll cut in September. How interesting. Let's see. So the Fed rate meeting, yep, September 18th is the last meeting before the election. I'm going to write that down. September 18th is the last meeting before the election. Last Fed meeting. They actually delayed their November meeting because of what's it called? They delayed their November meeting because of the election. Okay. So let's see here. Let's see. U.S. market is a joke, says somebody. There's some funny comments here. Okay, very interesting. Okay, so let's do a really quick summary of this. So, and then we can kind of look at stocks here. Let me quickly see what else the suits are saying, because I know there's some folks who are just now joining. So I just want to do a quick recap of everything for everyone. But let me quickly also look at gold's down 1%. Really? Oil's up. Yeah, gold's down 85 bips. That's wild. I'm gonna write that down. Gold down 85 basis points. You've got, obviously, the 10 years up. You've got oil up about 82.50 on Brent. Brent oil at 82.50. And then bonds, yep, up 10.7%. Wow. Pretty wowzers. Okay. Now, it does remove a negative catalyst, though, right? So that there's a chance, and it could just be hopium, but there is a chance that this is your worst report in 2024. Okay, so who knows? But again, that's what I think the Fed is going to wait for to confirm. Inflation expectations down. Otherwise, let's look at the 5-year break even. Entire Treasury curve shifted higher. How's our spread between the 10-2? Let me get a little more reaction here before we get our summary in. No, 10-2, negative 32. Not a big movement. And what is this? Largest jump in core services in nearly 2 years. Yeah, no kidding. That's crazy. I still think it's a January issue, but again, it could be delusional. Oh, that's okay. It's all right to have an opinion. So let's write that down. So that's quickly write that down. Largest jump in super core in 2 years. I called it super bad. Stupid. Okay. Dollar jumps. Is that true? Let me see here. If I go to FX. Okay. What about question of Fed? Oh, will this lead to the Fed talking about hiking again? I actually saw that. It was a Citigroup piece yesterday where Citi was talking about, will the Fed talk hikes again? Nobody wants to hear that. Citi asks, will the Fed talk hikes again? I don't think so. I think it's high for longer, but yeah. March just went poopy doops. All right. So, with that, let's grab. Oh yeah, and how's BTC moving? No, BTC. Yeah, I mean BTC's definitely had a little bit of an adjustment here. 49.2. Some of that enthusiasm's worn off, and you've definitely got some pre-market pain in a lot of different stocks here. But that's highly to be expected on a day like today. Okay, so for the folks who are just now catching up, we will give a quick summary of the day. Okay, ready? Holy smokes, not even life insurance prevented the disaster that we just had in CPI. This is bad. We basically just fully unpriced the March rate cut. The odds of a May rate cut have been reduced to about a third. We've got now maybe a full rate cut set for July. And we'll go through what happened with the numbers, but what I think is most important here is I think the Federal Reserve is gearing up for... We got to get past January, which, as Goldman Sachs says, which I believe as well, could be your January kind of price hike. A lot of personal services, hiking prices in January. Funeral services, accounting services, financial services, veterinary services, medical care services. I mean, across the board, we saw services really move up in January, which was unfortunate because, one of the things JP Morgan warned us about was that if we got a read of somewhere around 0.3 to 0.4, we would really be concerned about potentially this core reacceleration of inflation. And that's exactly what we got. We were looking for 0.277 on CPI core month over month. That's what we were looking for. We ended up getting 3.9. Well, I shouldn't put it as 3.9. It should actually be written as 0.39. There you go. But the point is, that's quite hot. If you annualize that figure, just sort of on the monthly basis, which is you multiply it by 12, you don't go exponential, you're at core inflation of 4.68%. But what's worse was supercore. Supercore came in so hot and is to some extent re-accelerating that some folks are wondering, oh no, is this exactly what the Federal Reserve fears? Remember, I throw this all over at ehack.com. Check it out, ehack.com. But what do you have here? And what is this going to mean for the election as well? We'll touch on this. But look at this. This is a chart of supercore inflation. The Federal Reserve wants to see inflation come down meaningfully. We really want to see supercore inflation probably settling somewhere around higher in the 2s. That way you can get goods disinflation drag you down. But what you actually have here is a reacceleration of super core. We have not seen a super core this super bad in 2 years. And I'll tell you, there's almost zero doubt that today, whenever Donald Trump is awake, we're going to be getting some Trump Truth Social posts about how bad inflation is and how it's essentially getting worse. And at the moment, Donald Trump is going to have a leg up in using that as a weapon. He's going to use that as a political weapon because, of course, why would you not? That's what we're dealing with right now. So the question then is, why? Is it possible that this is just a January number? Well, we have to balance that out. First of all, we get seasonal adjustments in January. So if this spike is just a January spike, we actually have to have more of a January spike than we had in prior months, or I should say prior years, right? Because if every January you have a spike, well, that gets seasonally adjusted away. If this January, which was a warmer January, you get a larger price hike above your seasonal adjustments, you end up getting this kind of reacceleration. We also, as we went through the actual CPI release, we wanted to see, hey, you know, were these numbers hot because of potentially weak seasonal adjustments? And as we were going through the actual item page by page over here, we compared the red highlights to the orange highlights. The orange are the seasonal, the non-seasonally adjusted numbers. The red are the seasonally adjusted numbers. The numbers were not that different, which is a sign that no, this was not an issue of adjustments. This was just an issue of broad-based inflation, which is not good. Again, it could be hot January, people spending money in January still more than expected, but it is going to be a political hot potato that Joe Biden has to deal with. And I'll tell you, after Kamala Harris yesterday suggests, hey, make sure you remember the warrants have been called for house hack at househack.com. No, that's not what she said. Kamala Harris yesterday said, I'm ready and fit to serve. A lot of people are scratching their head going, wait, this after the DOJ report on a decline for Joe Biden? Wait, is this the plan? Are we voting for Kamala Harris as president? Anyway, sorry, that was sort of a little side note. But basically, CPI is a very important measure, which folks will look at for when it comes to voting, because inflation really frustrates people. We even had grocery prices tick up again in January. Now, that does come at the same time as GDP is sitting at 3.4% on its current estimate for Q1, the first quarter, the first 3 months of the year. This is great. This is a great sign that the economy is doing well and moving strongly. But prices are still moving up at an unacceptable pace. And it's a broad-based spread, too. You can see some more of the details that we've thrown over at ehack.com, but it's a broad-based spread. It's various different categories. So the question now is, what does this mean for the Federal Reserve? A lot of folks come here to see my opinion on the Federal Reserve, and I'll tell you, I think here's exactly what the Fed is lining up for, okay? Look, March 20th only gives you the January and February CPI reports. That's not enough. If January is going to be a one-off and hot, you're really going to need 3 to 4 CPI reports to argue that January is hot and everything else is not. That's the only way you can argue that. So May is going to give you January, February, and March, but that only gives you 2 to balance out one hot. Probably not enough. You're probably leaning towards June. That way you can get the summary of economic projections in March. And June 12th is a really special day because you get the FOMC meeting, so the Fed meeting, where they make their interest rate decision. You're going to get the summary of economic projections, and you're going to get a CPI the morning of the meeting. So the meeting takes place at 11 a.m. California time. Inflation is going to come out at 5:30 a.m. California time. So you're whatever, 4.5 hours or whatever beforehand, you're going to end up getting, or 5.5 hours, whatever, you're going to end up getting the inflation report that morning. Now, some folks say maybe we'll be looking at the July meeting. Right now, July is fully priced for a rate cut. June's not. June's only at about 77%. But this would make sense because in June, you'll have February, March, April, and May CPI reports. Those 4 reports could offset a hot January. However, if all of those 4 reports are hot and they actually reiterate January, you're staying at these higher rates. Now, Citibank actually thinks there's a chance the Fed might have to start talking about interest rate hikes again, which would be wild, but I suppose it's possible if you end up getting multiple CPI reports that reiterate a potential acceleration again in inflation. Now, what's bizarre is we're not actually seeing this in inflation expectations. Inflation expectations coming in substantially lower over the last year. And not only are inflation expectations coming in substantially lower, but when you look at earnings calls of what we have with companies raising prices throughout our actual economy and what they're forecasting, you're not actually getting forecasts for price increases that would suggest growing or rising inflation. Here are the year ahead inflation expectations. You can see these here. 1 year ahead is this light blue number. 3 years ahead is the darker blue number. You've got stable 5-year inflation expectations, stable 10-year inflation expectations, which we could look at as either the 10-year break even or you could go the 5-year forward. That's just a fancy way of saying what's inflation 5 years out and then the next 5 years from that point. All of these numbers are very stable, very anchored, which suggest when you combine earnings calls and inflation expectations, you suggest that the January number could be a one-off hot figure. It has been a wet winter, but it's been a lot warmer. We haven't had the snow this year like we've had last year, or quite frankly, many years before that. Like if anybody out there is a skier, you're probably like, man, this has been a warm season. And it's not great. You know, the snow hasn't been that great, so it's a little bit of a bummer. But what does that contribute to? More service spending, people getting their tax returns done earlier, people getting, whatever kind of services they need done earlier in the year than usual. And that can lead to pricing pressures consolidated into January. Now, that's just an idea. That idea does align with what Goldman Sachs believes. Goldman Sachs actually pulled off the estimate the best. They thought that inflation would come in at 3.8%. It came in at 3.9 for that core figure, so they were closest. And as you can see, Nick T suggested here, 0.38 again. I always kind of move the decimal there when I say this. But anyway, they had a quote, "We expect a temporary boost to core CPI from start of year price increases, which we expect to be most pronounced in prescription drugs, car insurance, tobacco, medical care services." We did see all of that. But what you also have to remember is housing disinflation still isn't really coming the way we expected it would. We've been expecting rents to come down, more housing disinflation. Instead, we just had housing contribute 67% to month-over-month inflation, up 0.6% from the 0.4% we had 2 months in a row. So you're now seeing those 3-month and 6-month numbers move up, which I write here, did the Fed know? I kind of think the Federal Reserve did know. Why do I think that? Well, because Jerome Powell refused to talk about the 3- and 6-month inflation figures in the last Fed conference until he was finally backed into a corner to talk about it. And he's only interested in that 12-month figure, which I think that's because he probably knew January was going to come in hot. Now, it is a benefit that Jerome Powell suggested, hey, the numbers don't have to be as good as they have been. They just have to keep trending down on the 12-month. And that's probably why they're going to wait until June for those first cuts. So this is just going to take some more patience. Again, with a super core coming in at 0.85, which annualizes out to 10.2%, which is insane. Nobody sees an additional 10.2% inflation right now on an annual rate, right? It shows you how extreme January is. It really shows you how bad this report was. But I'll tell you, who's it ammunition for? Donald Trump. It's ammunition for Donald Trump, and it'll be accurate ammunition for him. You cannot tell Donald he's going to be wrong by using this against Biden for the next, essentially month or potentially even multiple months thereafter, because it's going to push our averages up. That stickiness, that is what the Fed is most concerned about. The Fed is concerned about the shelf right here, that this number is not going to continue to trend down. It doesn't even have to plummet like it did here. It just needs to trend down to like 2.5%, basically to be around this level over here, pre-pandemic. And any of this shelving, bad, really bad. So anyway, that gives us a breakdown on CPI. It was a bad morning. It's a bad report. It's not good. There's a chance it's a one-off, but that could be hopium. Either way, we're probably and realistically now looking at June or July. So in case you're wondering why a lot of stocks are red today, there you go. Oil up to 82.5 on Brent. Gold down. Bitcoin dropped a little bit off its 50K. Rough numbers. Risk assets selling off today.
Let's get that opening bell and the CNBC Real-Time Exchange. Today at the big board, packaging company Sunoco Products celebrating its 125th anniversary at the NASDAQ. Inspired Therapeutics focused on the treatment of inflammatory bowel disease. Rep fills in fairly negative here, Jim. We'll keep an eye on levels.
Yeah, Carl, interest rates are dramatically higher. People are trying to figure out what's going on. But most importantly, we've had a very, very big month. February's not that great a month. We're taking a breather here. We've had some really...
Okay, so let's find out how this market's actually going to move now. Boy, I'm I feel like I'm a little nervous to look how the market's going to move, but I feel like we should already know which way it's going to move. Here are the cues. You've got the cues moving, well, unexpectedly down. This should be no surprise at all that you're going to get some selling pressure here. Stocks are a risk asset, and the longer you have interest rates high, the more the risk assets will sell off. That's very normal. It's to be expected. It's not a big deal. It's the way it's supposed to work. So then the question is, how resilient is this economy going to be to this sort of information, right? That's a big deal. So the question then becomes, okay, can markets absorb this pain? And that's really not what we're going to get from the CPI report. Instead, that's really what we're going to get from just observing the market. And really, most importantly, how is it going to close today? Are we going to close substantially down? That is, are people really, like people who went long, are they that offended by this report? It's entirely possible. And if institutions and hedge funds and people across the board are so offended by this number, then yeah, this is going to be a little bit rough, and you're going to get some selling off. So, you know, be watchful of that. So we will. You've got Apple here turning slightly green. You've got the Q's kind of stuck at that negative 1.88. You do see that NVIDIA drop. Look at that NVIDIA drop. You were coming off of some insanity yesterday. Yesterday we ran up to $746 per share. $746. Today we get a 3% drop. And then it sort of begs the question, is it time to sell off some of the chip mania and start investing in HouseHack, baby? Warrants have been called, househack.com. We might, we've gotten so many messages of people asking us to do another accredited fundraise. It's on my mind. It's not really necessary, but I want to give folks, I love my audience so much. I wanted to take care of folks if y'all want to invest. But anyway, it does look like NVIDIA's trying to pull a green here again. So this is why I say the way the market closes today is going to be a big deal, because I would expect a lot of pain. But if look at this is crazy. If the market flips around again, it's kind of like, do people really care? Like, is this so bad that it's actually changing people's perceptions of where we're going? I don't know. But we will know more as the day progresses here, that's for sure. Look at that. The Qs are trying to turn green. Apple's bobbing around, slightly red there. I really am watching. Look at that. Meta's turning green, or pushing to green. Airbnb's pushing to green. Airbnb has earnings today. We're actually going to do a fundamental analysis in the course member live this morning. If you're not a member yet, you're missing out on good fundamental analysis we do on a daily basis. You pay once, you're in it forever. You do that over at meetkevin.com. Really, really good content and quality information that we go through every day. But yeah, look at this. NVIDIA, those green candlesticks are pushing here. Not only are those green candlesticks pushing, but wow, look at that. The 3% decline on Tesla is reversing. Holy crap. How do we get bad news is good news? What the hell is going on here? Whoever got the puts is like, what the okay, that's bizarre. That might not last, though. This is a little unusual. Okay, that's highly unexpected. You've got Palantir down 4%, but also trying to go green candlesticks here. CrowdStrike down 233. Cloudflare down 6.4. That one's keeping its head in the dirt. That one's continuing to move down a little bit. Super Microcomputers rotating green. You've got Under Armour down 3.6. Taiwan Semi down 2.6, somewhat stable. You've got Enphase only down 4%. Look at that, right off the support line. Holy crap, the Fibbies do it again. The Fibbies take charge once again. Folks really don't love when I do the Fibbies, but I don't know. I mean, I think the Fibbies, they tell us so much about our TAs. I mean, look at this. Look at this. This is Bitcoin here, and it really just shows you the price action, you know, the way it should be. It's incredible. So if you're not using basic Fibbies yet, I mean, this is not hard. But it's very incredible how consistent they tend to be. Let's watch if we can maintain those green candlesticks. I'm a little nervous. Yeah, Airbnb couldn't keep it up. I'm a little nervous. Those green candlesticks are a little fugazi. Yeah, there's Apple dropping again another 10 basis points or so. Nvidia's trying. Meta's trying. Tesla's still trying. Let's get MSFT going here. MSFT, what do we got? Now, when MSFT pulls green, that's a good sign that people are refusing to either give up on these, which means they're not selling as much as expected, or there's some form of buy the dip mentality that's going on. I'm not entirely sure exactly what's going on here. I will tell you, I did get to hang out with all three of my little baby triplets yesterday. Very excited about them. We're still not out of the woods on one of them. 2 surgeries down, 1 surgery to go, and pathology, trying to figure out what the hell caused this freaking problem. So still extremely stressful for us. But I know some of you all have been asking, so I thought I'd give you a little update. But it's hellishly stressful. Money and sticks and all this stuff is like just pure entertainment. Compared to health issues. So tell your loved ones you love them. Anyway, Amazon. Okay, we're continuing with the green trend here. Stable on Tesla there. I want to look at where are the big movers here. Okay, big movers here. ARM down 8% on the day. A lot of talk about a potential gamma squeeze here and some potential market manipulation here by SoftBank as their lockup comes up next month. They've got a massive lockup. They own a ton of the shares outstanding. There's a very, very little or a very small float. I think you've only got like 8 or 9% of the stock that exists outstanding on the market. And a lot of that's owned by SoftBank. A lot of the rest is owned by SoftBank. So they have the ability to just sort of like hold and not sell at the same time as, push some call option volume or whatever to manipulate this. A little nervous about that. Yeah. Okay. There we go. Let's do that. Okay. So let's take a look at some of the other things here. Rivian, certainly an interest rate sensitive stock here. Cars are very interest rate sensitive. That's one of the things I wish we had talked about a lot earlier. I've always considered certain companies as recession resilient, but then you also have to balance that with interest rate resilient, and they're very, very different. Very, very, very different. 23andMe down at 70 cents. I don't think that one's really moving on anything other than just the drama of it being a penny stock at this point. You've got Affirm down 8%. That's a little bit of a consumer fear there. Etsy 5%. The consumers are something that are really, really creating some concern for folks, but people keep spending. The bigger concern really seems to be China. And KWeb down 1% here with Alibaba. Let's take a peek at Alibaba. Alibaba, down about 82 bips. Not a big item here. Looking at what some of the other suits are saying. Let's see here. Oh, this is interesting. Okay, give me one sec here. What is this? Okay. Oh, yeah. Okay. So inflation is resurfacing earlier than expected. That's inflation is resurfacing earlier than expected. U.S. inflation for January surprised across the board to the upside, kneecapping the rally in stocks and bonds. One data point doesn't make a trend, but when you combine the slowing disinflation trends with the raft of leading indicators pointing to price indicator, what raft of leading indicators? Let me take a look at that. That I think is very interesting because I personally don't see a raft of leading indicators. But then again, you have some funniness here. Let's see what we have here. Another inflation report, blah, blah, blah. Leading indicators of wages, profits, and supply constraints. Okay, hold on a second. We have to parse that out here. Wages can affect services inflation. That's true. And we have seen warmer wages. That is true. That's fair. Supply constraints regarding the Red Sea do not necessarily increase consumer prices. So you have to be careful. And profits don't increase consumer prices either. Now, profits could go down based on absorbing inflation without passing on the price increases. But profits could also just be due to people still having more money and spending more money, right? So I think out of those three, I think it's right to say that, yes, wages rising and real wage gains, which is what Janet Yellen and Jerome Powell want. They want real wage gains. That's a good thing. And yes, that could be contributing to services inflation. Absolutely. But to suggest that the supply chain issues and then profits are leading indicators of CPI, I personally disagree with that. Could be wrong. I just disagree with that. I think that's nonsensical. Inflation upsets the Goldilocks narrative in markets. Today's print undermines Powell's view, fully embraced by markets, that the economy can keep growing and inflation can keep moving lower at the same time. It does. It does undermine that. It doesn't destroy that, but it does undermine that. What I think is so fascinating this morning, though, is that consumer stocks are getting hurt. So let's write this down for a moment, okay? Let's do a little project here. Okay, we're going to get a notepad. Let's do this together. What do we have here? So I'm not talking Chinese consumer stocks either. Microsoft, and I'm not talking mega caps. So Microsoft's trying to recover some of that damage. Bitcoin's under 49. Apple's not. So Apple is hurt. And then I want to look at like Visa and MasterCard as well in a moment. Airbnb's trying to recover. Facebook's losing it there. Amazon's trying to recover. Still. I don't know how long that'll last. Tesla's honestly only down 149. Like, that's not bad. I'll take it. CrowdStrike recovering nicely here. Cloudflare still down 5. Bill.com 4. Affirm's down 9. Look at that. Why is Affirm down 9.6%? That's a biggie. But it's not just, like, look at this. If we just go by the leading decliners, Affirm's in here, Etsy, SoFi, both of these guys about 6%. So that's very interesting. Peloton down 5. Is this because of, like, credit card interest rates or what? We can look, I'm just looking specifically at, like, consumer goods. You've got Under Armour down 4.5%, D&B down 4%, so Play stock down 4.5%. What else? Where's another consumer stock? Why is Intuit down? Well, that actually might be a buying opportunity for Intuit finally. I mean, it's going to a support line. We got to break that. That'd be nice. But let's go down to what's rising, like nothing. Like, nothing's green. What about MasterCard? MasterCard's barely down. You know, MA is only down 0.27%. Starbucks, McDonald's, Ulta, Costco's down 1%. But none of these guys are actually down that bad. And then if I go to, how about Visa? Let's try Visa. Visa. No! MasterCard and Visa barely down. I mean, 5 basis points? That's odd. So why, it's not the credit cards that are going down. It's really, I think it's more some of the more, I don't want to say speculative, but maybe the more retail related stocks, right? The retail bet stocks. That's what I'm going to call it. Maybe like retail momentum versus classic blue chip, right? That would be the way to do it. Like if retail had sort of a retail basket, retail momentum basket, what would that consist of? Those like Affirm, Etsy, SoFi, Peloton, those would be pretty consistent there. Is Shop also going down? Let's take a look at that. Shop. Oh, wow. Yeah, 8.6% on Shop. That's a good one. Yep, that's another good little retail basket there. I agree with that. Trade Desk down 143. Yep. So, yeah, that's no bueno. You've got Microsoft. Let's do a little look here. Microsoft, K-Web. No. Visa, no. Okay, this is all consistent. Q's. Get out of the way. Yeah, Q's giving up a little bit there. Nvidia, though. You just can't bet against it. Or Meta. They're just holding stable right now. New York Community Bank. Still not bankrupt. CrowdStrike's almost at 0. and some volatility. Again, a lot of this will depend on how the market closes today, but we shall see. Oh, Shop had earnings this morning. Let's look at Shop earnings. We'll do a quick look at Shop. Shop. All right, so... All right, what do we got here? Shopify. Beats on Q4 rev, beats on Q4 adjusted EPS, beats on Q4 merchandise, beats on Q4 recurring revenue, Q1 margin boost. What the hell? It's all, like, they beat on everything. What? Overshadowed by light free cash flow view. Really? They beat on everything. Shopify. Let's see here. Fourth quarter financial highlights. Full year highlights. 2024 outlook. Here we go. Okay, first quarter we expect... Okay, what is this? Note, year-over-year comparability and our financial outlooks will be impacted by the sales of our logistics business. That's fine. Free cash flow as a percentage of revenue to be in the high single digits with sequential improvement throughout the year. That's it? That's what people are upset about? Free cash flow slowly growing up? Free cash flow was in Q4, well, actually in 2023, was about 13%. So they're saying high single digits, so there's a reduction there. But that doesn't seem like a big deal, man. Yeah, that's very interesting. All right. So, well, anyway, hey, thank you so much for being here. I appreciate you hanging out with me for CPI. You know, it's like 6,500 people at CPI release time that could have spent their time listening to somebody else and chose to hang out with me for CPI. So appreciate that. That's really cool. But yeah, I'm gonna push the button now. Here you go.
Go yourself. Is that clear?
My bad. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. There you have it, folks. We're going to make another cup of coffee, and we're going to the course member